Thank you. So good evening, everybody. And I'm going to talk about bonds. Just before I do that, just a bit of important information I must share with you. So I suspect most people are much more familiar with what equities are. You've had two equity presentations. If you're an equity holder or own equities, you actually own a stake or a portion of the business. A bond holder is somebody who lends money to the company. So they owe you money, but you don't actually own a portion of the company, and you don't get any votes, for example, at the annual shareholder meeting. So some of the features of a bond, you typically have a fixed coupon or a yield or a rate of interest that is paid to you on an annual basis. You'll get your money back at a certain period of time. All bonds are different. Maybe it's a 3-year bond, 5-year, 10-year, up to 30-year, and then sometimes you get 100-year bonds. So bonds that will pay you a certain coupon for 100 years. You rank senior to shareholders. So in the unfortunate environment where a company may go bust, you will get your money back first. I would say, though, however, what we have to understand is risk and reward. A bondholder is the blue section at the top, so you're the first person back in terms of, as I said before, if a company goes bust. However, with that lower risk goes typically a lower return. So you go to the bottom of the screen and you see the red section. These are the highest risk securities, but equally you are much more likely to gain a bigger return. With bonds, the bulk of the money that you make will come from income, whereas in the equity market you should expect over time that the bulk of your return comes from capital appreciation of the shares. So bonds and equities are different risks, different return characteristics, and they really play part of your portfolio as a diversifier, basically not having all of your eggs in one basket. Now, while bonds are lower risk on the whole than equities, there are risks within bonds. There's two key types of risks. There are interest rate risk and credit risk or default risk. So just to talk about interest rate risk to start off with, on the whole, when the Bank of England puts up interest rates, typically what a textbook will tell you is that should be bad for the bond market, because the bond that you currently own or already exists has a predetermined coupon, and therefore when the broader level of interest rates rise around the world, then your coupon is fixed, and therefore in order for that coupon to be adjusted for the prevailing rate of interest around the world, the price falls in order to deliver a higher yield. So if interest rates go up a lot, as they currently are in the UK right now, that you typically consider that to be bad for bonds. I'll come on to it in a moment, but what we have to bear in mind is the market's very good at predicting things. So just because interest rates went up today, for example, the bond market actually was strong, it went up rather than down because the market had already predicted it. The other type of risk is that what happens if a company goes bust, default risk or credit risk. And there's different levels of credit risk. Here is a chart or a table to show you the different levels of credit risk that you get. The fund that I manage, the Artemis Corporate Bond Fund, is an investment grade corporate bond fund. So we invest in the highest quality or the safest corporate bonds. The non-investment grade bonds at the bottom of the page, they are also called high yield or junk bonds. And while our fund has limited capacity to do that, the vast majority of what we buy is at the top end. Now, there's 3 major rating agencies out there. You may have heard of Moody's or S&P before. There's a third one called Fitch. They have different ways of categorizing it, unfortunately, to make it a little less standard. But just to give you a bit of a feel for where the UK government is, for example, on this table, it comes in around about AA-. And this is why credit risk is important. So if you're a AAA rated bond, and there are very few companies or have that very high credit rating status, it really, the German government bonds, for example, are one of the few AAA rated assets still around in the world. But as you can see, as you go further down the risk spectrum, from the strongest investment grade of AAA down to the weakest high yield bonds, the triple Cs, the risk of default increases exponentially. Now you get a higher level of income for those bonds, but with that goes a higher level of risk. Just to repeat, the bonds, the fund that I'm talking about tonight, investment grade corporate bonds, have a very low risk of default. Just to give you a feeling for how a bond yield is constructed. So, you know, from a corporate bond, this is an example is a Becton and Dickinson bond. They are a medical supplier. There's two elements to a typical corporate bond. There's the amount of yield that you will get on an underlying government bond, in this case a gilt, the dark blue section, and then you get the lighter blue section is the additional yield that you get for the extra risk of lending to a company over a government. So a corporate bond or a company is much more likely to go bust than a government, particularly if you're looking at the UK, Germany, or the US, for example. And therefore, this light blue section is called the spread or the credit spread. But together, the combination of the underlying government bond and the credit spread delivers you an overall yield. And what you can see here is the yield level does go up and down depending on the overall market conditions and also the strength or weakness of any company at any one particular moment in time. Just to give you a bit of a feel for these two aspects of a corporate bond, on the left-hand side we show you a 10-year history of the spread, that additional yield that you will get on the average corporate bond over time. It goes up and down quite a bit, as you can see. As you can see for here, if you go back to 2011 or 12, you can see that you've got considerably more spread or yield during the euro crisis. Go back to 2016 when there was concerns about commodity prices when they collapsed, and also there's some concerns around growth in China at that time. 2020, of course, was the concern about COVID. So you know, people were felt more risk averse. Therefore, the yield that they required to lend to companies rather than government shot up dramatically. And then more recently, obviously, we've had concerns around geopolitics and war. So that's one aspect of the yield going up and down. On the right-hand side is the underlying yield level from the UK government bond market. This is a 10-year gilt, for example. Yields fell to their all-time low in the UK during COVID, but you can see that as economic growth has come back strongly and as interest rates have started to rise again, you can see the underlying government bond market yield has also increased. So both these aspects are at play. The market goes up and down, just like the equity market, less so, but still goes up and down. And you know, my job, quite simply, is to try to buy bonds that are, you know, have attractive yield and hopefully don't sell off too much when the market is weak. Now, the first speaker James did mention inflation in his presentation. Inflation is clearly, you know, a hot topic at the minute, and as you can see here, the dark blue line is the inflation or RPI prints that we've had over the last 12 months, and the light blue section is what it is forecast to be. So we could be looking in around about April or May time with RPI or inflation prints in the UK at double-digit figures at 10%, incredibly high. The inflation environment has shot up quite dramatically. The brown dashed line shows you what we were thinking only about 6 or 7 months ago and where inflation might peak. So inflation is clearly a concern, and typically that is a you know, not good for bond markets, but equally it's a challenge for most markets as well. Something I touched on very briefly at the top of the call was that what we have to bear in mind is the bond market doesn't sit there and wait until the Bank of England decides to put up interest rates. The bond market reacts to the overall economic environment, and typically what you find is it will move dramatically well in advance of the Bank of England raising interest rates. So you can see what the blue line here is what the market was predicting at the very start of March, where interest rates in the UK would get to. This moves quite a lot. Right now, the bull market has moved on since this chart was graphed. We are predicting that the market is predicting that base rates in the UK will be 2% at the end of this year, and will peak about 2.25% in the summer of next year, and then start to fall thereafter. Now, this is not a forecast or a recommendation, but my own personal view, it is highly unlikely that interest rates in the UK will reach those levels. Just very quickly on my own fund, we are an actively managed fund. You've heard Ryan talking about that earlier. We have in the region of 120 holdings in our portfolio. Some of the largest funds in the market have 500 or 600 holdings. I would argue it's very difficult to deliver any return from stock selection when you've got that many bonds. You become a closet index tracker. That's clearly not what we are. So we think we have a prudent amount of diversification, about 120 holdings, not being too concentrated, but equally we are still very much an actively managed fund. Just very briefly, there's a lot of data on this slide which I won't dwell on. The environmental impact of your investments is becoming increasingly important. And just in the top right-hand corner here, you can see the thing that we focus on the most is the carbon intensity of our portfolio, and it's running at about half the level of the broader market. So we have a very small carbon footprint compared to the bond market as a whole. Just very briefly on fund performance. This fund was only created in October 2019, but the performance has been very strong since we launched. The fund has substantially outperformed either the average corporate bond fund in the market or the index that we are actually specifically benchmarked against.